Eliot's most important observation is that the crowd does not move from extreme pessimism to optimism in a random fashion. It doesn't get there in a straight line. It does it through a series of psychological stages. The first stage he simply labeled wave 1. This is a rebound from the depressed levels at the actual bottom. It's a recognition of survival by the market, a realization that the worst has passed. Now, most participants don't necessarily understand that to be true, but the market is reflecting that by making its first wave up. Wave 2, then, is a partial retracement of wave 1. It's a severe test of the conditions that existed at the actual bottom. Sometimes when you look at those fundamental background events or situations, some people can actually argue that the fundamentals are worse, or at least as bad as they were at the actual price low, and yet prices hold above the prior low. This wave 1-2 pattern forms a base. This is the launching pad for wave 3. Wave 3 is usually, particularly in the stock market, the longest, strongest, and broadest move in a sequence. It's usually the longest in terms of time and price movement. It's the strongest in terms of the rate of change on the upside. And it's often the broadest, particularly relative to wave 5. And by that I mean in terms of the advanced decline figures. More stocks will be moving up relative to moving down in wave 3 than they will be in wave 5. As wave 3 progresses, psychology begins to change. You see, the average investor is 2 steps behind the market. Don't forget, this progression started with a bear market low. Most people were petrified by the end of that bear market that it was going to continue. When wave 1 occurred, a lot of market watchers said, don't believe it. This is a rally in the previous bear market. It's a trap. When wave 2 gets underway, people say, okay, the old bear market has resumed. Now, there are a lot of ways that you can verify this observation. It's not just an assertion. If you keep technical indicators of market sentiment or psychology, you'll find that at the bottom of wave 2, sentiment reflects a very powerful pessimism. Sometimes I have seen that pessimism be greater than the pessimism which occurred at the actual low. Once wave 3 begins, however, this starts to change. Early in wave 3, people are still holding on to the idea that it may merely be a rally in the previous bear market. As wave 3 progresses, there is a center point where the acceleration is the strongest. I call that the point of recognition. It's when most people in the market finally decide that the major trend is now up. There is no question about it. On those days or weeks or months, you will see extreme volume, very powerful breadth, breakout type activity. Psychology continues to change as wave 3 progresses. By this point, people are pretty optimistic about the future. You see, they've changed their minds. The major trend is no longer down, it's up. Well, by this point, they're probably, you see in the center of wave 3, they've covered all their short sales at that point of recognition. By about here, they're 50% invested. Somewhere along here, they may approach 100% invested. Right about there, they're buying options on their positions. And right here, they're buying futures contracts as well. And just after the top, if they're really bold because they're assuming this is a pullback in the uptrend, they're buying options on the futures. Well, that's why wave 4 is labeled a surprising disappointment. Wave 4 is a normal retracement. As you can see from this graph, wave 3, if it's usually the longest wave, has traveled a long way, and a correction is long overdue. A correction is exactly what the doctor ordered. The market gets it. But you see, because of the extreme optimism that was generated by this wave, the fact that people finally moved from underinvested to overinvested at the top, sets them up for a disappointment and probably even for a net loss on their positions. Once wave 4 is over, wave 5 begins. Wave 5 is the final movement in psychology toward the upside. As wave 5 begins, people regain their confidence. They say, well, we made a decision during wave 3 that the long-term trend is up, and this movement to new highs is confirming that conviction. We have no problems with this basic market. We can get invested again. We can be comfortable. Of course, wave 5 takes you into the final high, and wave 5 precedes the largest correction since the entire sequence began. Now, the fifth wave is obviously the most important one to recognize in the entire sequence, because it's going to alert you to the fact that the biggest correction, if it's a smaller degree, or bear market, if it's a larger degree, since that 5-wave sequence started, is about to occur. Fortunately, the fifth wave is the easiest wave to recognize from two different aspects. There's a technical aspect and a fundamental aspect. From a technical point of view, the fifth wave is virtually always weaker than the third in just about every measurement. It doesn't have to be shorter than wave 3, but if you analyze the technical development of wave 5 in terms of speed of price movement, and probably most important, the participation of stocks, you will find that it is weaker than wave 3. Breadth begins to thin in wave 5. I've found this true not only in fifth waves that last a year, but in fifth waves that last a day and a half. If you compare them to the power of wave 3, you will find that the advanced decline participation is not as strong. That's probably the biggest technical key to identifying a fifth wave. Usually, particularly on smaller degrees, intermediate and lower, volume will also be less in a fifth wave. There's less power there. People got heavily invested in the third wave and they haven't got that much buying power left, and it shows up in the technical condition of a fifth wave. The second area is the fundamental area. In virtually every case, you'll find that a fifth wave has problems behind it that the third wave did not. Now, keep in mind that a fifth wave follows wave 4, and wave 4 is a correction, and usually the fundamental news background during a fourth wave is pretty bad. It's gone from the positive background that wave 3 finally generated to a weaker, scarier background that gets people out at the correction low of wave 4. So the fifth wave does show an improvement relative to the fourth wave, and that gets people very optimistic. They say, look, things are getting better. But if they stepped back and observed the chart and then said, now let's go over in our minds what the fundamental conditions were in wave 3 and compare those to what's happening today, they would have to respond that today's fundamental situation is not as strong as it was in wave 3, and that is another very strong indication that wave 5 indeed is in. Now, do you know that in the entire wave principle there are only 3 rules that you have to follow? Now, the reason it's important to stress the rules and remember them is that most people don't. And if you read a lot of armchair Elliott interpretation, by that I mean a chart with letters and numbers on it that don't necessarily correspond to what R.N. Elliott suggested, you will find that these rules are broken by a lot of practitioners, and that's one reason why some practitioners find they're wrong. The rules are there for a reason. They describe the real way that prices behave. And if you try to say, this time it's different, this time I'm going to throw away the rules because my opinion comes first, you are going to end up making mistakes. What Elliott did above all was to describe reality in the marketplace. It's a somewhat complicated discussion once it's all over. It's going to take us 2 full days to cover every aspect, but it's important. Rather than just having a black box indicator that says, well, here's one aspect of the market and we'll use this to make our decisions, what we're going to try to understand is the entire reality of the way prices are moving. Here are the 3 rules. If you write them down and if you don't break them, you will be better than most people who dabble in this approach. The first one has to do with the second wave. Wave 2 cannot go to a new price low. It can retrace up to 100%, but it can't go to a new low. Second waves can also occur as rallies, and then they can't go to a new high. The basic summary is that a wave 2 cannot move beyond the start of wave 1. The next rule applies to wave 3. Wave 3 can never be the shortest wave. Now, that is not to say it must be the longest. It merely can never be the shortest wave among waves 1, 3, and 5. So-called impulse waves, 1, 3, and 5. Wave 3 will never be the shortest of those 3 waves in terms of price movement. The third rule has to do with wave 4. Elliot observed that a fourth wave never ends in the price territory of wave 1. A fourth wave never ends in the price territory of wave 1 in the classic 5-wave sequence. You can summarize that by calling it the non-overlap rule. And on this picture, in a bull market, it merely means that wave 4 cannot fall into the price territory of wave 1. It cannot come down and overlap the peak of wave 1 in terms of price. From here, we're going to take one big step forward. This concept is central to the wave principle. Let's suppose that this chart we're looking at right now is a yearly chart of stock prices over several decades, and you see a very clear 5-wave structure, but curiosity strikes you, and you say, I wonder how each of these 5 waves subdivides. Well, Elliot had that curiosity, and he looked very hard to make his conclusion, and he discovered something very interesting. Wave 1, if he looked at the subdivisions, took a 5-wave upward shape. In other words, if you took wave 1 on your yearly chart here and made a weekly chart showing only the subdivisions of wave 1 and blew it up on the chart so you could see the subdivisions clearly, you would see exactly this picture. Now follow it through with me, because the psychology is just the same. Remember, we had a major low here. Coming off that low is wave 1, the recognition of survival. Wave 2, the pullback that people think is part of the previous bear market. Wave 3, the strong middle portion. Wave 4, the pullback. And wave 5, right into the peak. What happens after wave 5? The largest correction since the sequence began. And that 5-wave movement becomes a building block for the next larger 5-wave movement. All right, what about wave 3? The answer is, if you looked at a subdivision of wave 3, you should see, essentially, this picture again. The same thing is true of wave 5. Subdivides into 5 waves right into the peak. These are called impulse waves, and remember at the outset I mentioned that 5-wave structures such as this are how the market breaks down when it is moving in the direction of the one larger trend. In this case, the one larger trend is up, and therefore the waves moving upward of one smaller degree will take the 5-wave shape. Now, how do waves 2 and 4 subdivide? Waves 2 and 4 are moving against the trend. They're not going with the trend of one larger degree. They're moving against it. Well, a couple of things happen. First of all, instead of moving with the underlying tide, they're moving against it. And therefore, they never are allowed to develop the full 5 waves of psychology in the opposite direction. There's too much underlying pressure keeping that market from giving you a 5-wave structure in a counter-trend move. There are no 1, 2, 3, 4, 5 structures which are complete counter-trend moves or corrections. The second thing that happens is, since there are various strengths in the advancing phases for the correction to work against, there are various ways that the market can create a correction. So not only do you not see a five-wave structure, you see a lot more variety in corrections. Bull markets tend to be a lot easier than corrections because there is only one major shape. We just saw it, the five-wave structure, when it's moving in the direction of the one larger bull market. But moving against the trend, you see something different. You see different ways that the market can subdivide or create a corrective pattern. Now, we're not going to go into all the details right now about what these corrective patterns look like. There are 10 different corrective patterns, and we're going to cover those this afternoon when we get into the real nuts and bolts of things. But I want you to understand that when we start looking at these real-time pictures, you won't be seeing 1, 2, 3, 4, 5s against the trend that look like the five-wave structure we just studied. Corrections are a variation on the three-wave theme. Elliott labeled them A, B, C. Sometimes they'll have a rally in between and give you another A, B, C, but there's a repetition of the three-wave theme instead of the five. If this is the standard shape of a bull market, which is moving in the direction of the larger trend, you will now understand why I published this chart in November 1982 in the Elliott Wave Theorist. The market from the depression lows of 1932, a bottom which followed an 89% collapse in stock prices, was developing in the classic five-wave structure that R.N. Elliott described. We had seen a first wave up, a second wave pullback, a long third wave in the middle, a fourth wave correction, and A.J. Frost and I were making the case that we required, because of the typical movement of psychology, a fifth wave to great new heights, not 1,000 on the Dow or 1,200 on the Dow, but something close to 3,000. Let's see how that worked out. This is the Dow Jones Industrial Average on a monthly basis going back to the early 1920s. Here you can see this terrific bear market collapse in stock prices from 1929 to 1932. Now let's see how this sequence reflects the five-wave development that we discussed earlier. Of course, this low occurred amidst a good deal of fear, a good deal of worry, arguments that perhaps this market was not going to survive. There was definitely a question of survival. Some people were saying the bear market is not over, it's going much lower. The founding fathers made a big mistake a long time ago. They set this thing up in such a way that it can't continue to work. People were beginning to cast their eyes to Europe and study some of the fascist models being developed over there and saying maybe we should change our way of government and so forth. Good deal of fear. We were in the worst, or entering the worst period of economic depression in the memory of everyone living at the time. It was later described or labeled the Great Depression. Plenty of things to worry about. Lots of reasons for people to say we shouldn't be buying this market. There are too many things to worry about. Of course, if you study the history of markets, this is the kind of environment that creates the low, and it's exactly when you should be buying. Let's see what's happened from this point forward. From 1932 to 1937 was a first wave up. A lot of it occurred during the period that was described as the Great Depression. It was a recognition by the market, however, that it was going to survive the terrible conditions that existed at that low. In fact, few people realize that this amount of price movement, almost a 5 times multiple in less than 5 years, is the best upward movement of this century in terms of percentage gain over time. When it was over,